Imagine a brilliant architectural engineer sitting alone at a dimly lit desk while staring blankly at a trading account that just lost $40,000. This highly educated professional recently spent 3 long years studying complex market cycles, yet completely failed to hit the sell button when prices collapsed. You might think this devastating mistake only happens to reckless gamblers, but the scary truth is that your brain secretly uses the exact same software logic. Psychologists have spent decades trying to track down the hidden evolutionary bug that systematically forces intelligent people to make absolutely terrible decisions with cash assets. Before this video ends, you will understand the exact mathematical illusion that causes sudden financial ruin, even when someone believes they are being perfectly logical. I dedicatedly break down one powerful psychological concept per video in plain English. So if you want to protect your savings, then please subscribe right now. Let us open the hood of our minds and analyze why someone can easily lose their entire life savings through a process called mental accounting. The groundbreaking Nobel Prize-winning economist named Richard Thaler officially proved that human beings do not treat all money as completely equal or interchangeable assets. Your mind naturally creates invisible psychological files for different types of income, which completely alters your basic willingness to spend that hard-earned money. Think about the last time you found a random $50 bill on the street versus earning that exact amount working hard overtime. You will almost certainly spend that unexpected bonus money much faster on luxury items because your brain labels it as free fun cash resources. This simple cognitive shortcut feels completely harmless on a weekend trip, but it becomes incredibly dangerous when applied to major life investments or portfolios. When an ordinary person starts tracking their net worth, they mistakenly assume they are calculating numbers with cold, objective mathematical precision every single time. What most people never realize is that your subconscious mind is constantly placing emotional price tags on assets based entirely on where they originated. If you inherit $20,000 from a beloved relative, you will treat it with far more cautious respect than a casino winnings payout. Before I get to the most counterintuitive part of this behavioral trap, let us first understand how large companies exploit this exact vulnerability every day. Modern tech companies spent billions designing digital payment systems that intentionally reduce what cognitive scientists call the real psychological pain of paying out money. When you tap a plastic credit card or scan a sleek smartphone screen, your brain fails to register the actual loss of financial resources. This intentional friction reduction tricks your inner mental accounting filing cabinet into categorizing the transaction as an elite digital event rather than real loss. But here is the major turning point where an average spending habit accelerates into a massive historical tragedy for the unsuspecting investor or builder. Once your brain commits hard-earned capital into a failing venture or a dropping asset class, a secondary cognitive bias immediately takes full control. Psychologists officially call this secondary behavior pattern the sunk cost fallacy, and it remains the single primary cause of long-term wealth destruction. Researchers named Hal Arkus and Catherine Bloomer famously demonstrated this effect by proving people will actively force themselves to consume things they hate. Their classic study revealed that individuals who paid full price for a theater ticket would drive through dangerous winter blizzards just to watch it. Conversely, the individuals who received an unexpected discount on the exact same ticket comfortably stayed home, safely next to their warm, cozy fireplaces. Both groups faced the identical dangerous weather scenario, but the full-price group felt an intense psychological need to justify their spent cash. Your mind hates admitting that a past decision was a total failure, so it commands you to keep investing more time and cash. This is the exact reason why governments famously kept spending billions developing the Concorde supersonic jet, even after knowing it would never make profit. Historians now call this historical event the Concorde effect, because 2 entire nations refused to accept their massive losses and cut their ties early. Stay with me now, because what I am about to show you in the next 2 minutes changes how you look at your wallet. Think about your current life right now and realize how many times you bought things simply to justify something you already spent money on. You might keep fixing an old, unreliable car that breaks down every month because you already paid $2,000 for a new transmission. The cash you spent yesterday is completely gone forever, and it should never influence your logical decisions about what path to take moving forward. Professional Wall Street traders train themselves for years to completely wipe their mental memory clean every single morning before the market bell rings. They look at their current positions with completely fresh eyes and ask if they would buy this exact asset at today's specific market price. If the honest answer to that question is a definitive no, they immediately click the sell button and accept the loss without hesitation. The average retail investor, conversely, protects their fragile ego by holding on to a crashing stock until it hits absolute zero value on the screen. They tell themselves that a loss is not officially real until they sell the asset, which is a massive delusion of mental accounting logic. This exact behavior pattern explains why smart people stay trapped in dead-end careers or keep funding failing small businesses for many years. They look at their college degree or their decade of hard work and mistake that past investment for a reason to stay miserable. Companies know you operate this way, so they build clever subscription traps that offer free trials followed by difficult cancellation phone call procedures. Once you invest even 5 minutes customizing a software application, your mind instantly overvalues the tool due to the powerful psychological endowment effect. You will gladly pay $15 every month for a tool you barely use just to protect that small initial investment of personalization time. The absolute ultimate peak of financial intelligence is learning how to detach your personal ego completely from the current market value of assets. Money does not care about your hopes, your dreams, or how hard you work to earn that specific stack of green paper bills. Currency is completely neutral, and it only functions properly when you manage it based on future potential rather than past emotional attachments. Understanding this structural reality allows you to observe market drops calmly without experiencing the deep ancestral panic that forces dangerous emotional selling. Your brain did not evolve to manage digital stock portfolios or complex global currency markets, so you must actively build artificial, logical guardrails. If you fail to design a strict rules-based system for your cash, your ancient survival instincts will consistently treat losses as physical threats. This evolutionary misfire causes the classic double-down response, where people deploy more capital into a sinking ship just to feel temporarily safe. So let us pull this vital information together into a clean, actionable roadmap so you can easily avoid these hidden cognitive wealth traps. First, remember that every single dollar you own has the exact same value, regardless of whether it came from hard work or luck. Second, accept that your past expenditures are completely dead-sunk costs that must never dictate where you deploy your next unit of capital. Third, consciously force yourself to evaluate your investments every single month, as if you were discovering those asset classes for the very first time. People who understand these deep psychological principles consistently make vastly superior choices because they manage money with absolute clarity instead of emotional hope. Please share this video with one person you know who genuinely deserves to understand these hidden forces before they make a major mistake. Having just one honest conversation about cognitive biases could completely save someone you care about from facing a massive, lifelong financial disaster. The ultimate goal of true financial education is not learning how to get rich fast, but mastering the silent patterns that keep you secure. When you finally break free from the mental accounting trap, you reclaim absolute power over your future path, without carrying the heavy baggage of yesterday. If you want to continue mastering the complex, invisible psychology behind human behavior, make sure to hit the subscribe button right now.